You can either drown in the chaos of financial noise or discover a blueprint to beat the market, one that's rigged in your favor. What if the secret to retiring years, even decades early, is not about luck, but about mastering 5 proven investment strategies that consistently deliver results most investors only dream of? Nifty delivered a 10.6% annual return, while USA S&P 500 delivered an 11.7% compound annual growth rate from 2010 through 2025. But you think the market is unbeatable, right? Wrong. Brace yourself. This video proves otherwise with stats and actual examples. Rakesh Jhunjhunwala's high-conviction, undervalued picks made a jaw-dropping 40% plus compound annual growth rate over 22 years, while Peter Lynch's buy what you know mantra delivered 29.2% annual returns over 13 years. Stop trading precious time for money. It's time to make money work for you. Hold on to your seat. You'll uncover 3 investment hacks guaranteed to fast-track your journey to early retirement. But more on that later. By the time you finish this video, you'll have a clear roadmap on how to stack the odds in your favor and supercharge your investments. Let's dive right in. At number 5, passive index investing. Ride with the market. Passive index investing means putting money into a broad market index like the S&P 500 in USA or India's Nifty 50 and simply holding it. On the surface, it sounds ordinary, but here's the twist. Matching the market often beats chasing it. In India, only 25% of large-cap mutual funds beat the Nifty 100 index over 3 to 5-year periods. Passive investing also slashes risk. You diversify across all big sectors so no single stock can ruin you. And with ultra-low fees, you keep most of the gains. Put bluntly, the average active manager rarely beats the index, so you're better off riding the whole market wave than fighting it. As Bogle famously advised, don't look for the needle in the haystack, just buy the haystack. This approach relies on the overall growth of the economy rather than attempts to outsmart it through active stock selection or market timing. The Nifty 50, India's benchmark index, has delivered nearly 11% average annual returns over the past 15 years, consistently surpassing inflation. The S&P 500 index has outperformed a staggering 90% of actively managed large-cap mutual funds over the past 15 years. If you're enjoying these powerful insights into building true wealth, hit like and subscribe to the channel. We're just getting started. At number 4, we go for finding hidden gems. Value investing. Value investing is the opposite of chasing hot stocks. You find solid assets priced lower than they're really worth, then hold them patiently. This strategy is timeless. Warren Buffett, the ultimate value investor, says, "Be fearful when others are greedy, and greedy when others are fearful." In practice, this means buying when markets panic and selling when everyone else is desperate to buy. But what is the core idea? Buying stocks significantly below their intrinsic value, the genuine worth determined by a company's fundamentals like assets, earnings, and future growth. Value investors patiently conduct in-depth research to identify which potential stocks are undervalued and wait for the market to acknowledge the company's true value. The results are astonishing. Buffett's own fund, Berkshire Hathaway, returned about 19.9% per year from 1965 to 2024, nearly double of the S&P 500's. In simpler terms, $1,000 invested with Buffett in 1965 would be nearly $55 million today, whereas $1,000 in the S&P would be just $400,000. That gap is the value advantage compounded over decades. Consider Buffett's bold move after the 1987 market crash. He invested over $1 billion in Coca-Cola shares. That initial investment is now worth over $25 billion, not including billions earned from dividends alone. Another incredible success story is Titan. In March 2003, its intrinsic value was 93 rupees, but the market price was only 50 rupees. An investor would have seen an approximate 25.1% compound annual growth rate over the next 20 years. Turning every 1 lakh into about 81 lakh by 2025. Value investing isn't about panic. It's about seizing bargains and staying calm when prices rebound. Strategy number 3, growth investing. Catch the rockets. What if I told you there's a way to turn a small investment into a life-changing fortune? Imagine getting in on the ground floor of the next big thing, watching your money soar by thousands of %. That's the thrilling world of growth investing, where you bet on companies with explosive potential, prioritizing massive capital appreciation over immediate income. It's about riding a multi-bagger and seeing earnings skyrocket, directly translating to higher stock prices. Take Amazon, for example. After going public in 1997, its stock jumped an incredible plus 966% in 1998 alone. An early $1,000 investment would now be a whopping $2.3 million, a phenomenal 32% annual return. Or consider Nvidia, the chip giant. Its stock was up an astonishing 819% in 2023 to 2024 alone. Over the past 2 decades, 2005 to 2024, Nvidia generated a roaring annual return of 39.2%, significantly beating the market. India's rapidly expanding economy is a hotbed for such opportunities, especially in information technology, financial services, and green energy sectors. Companies like Bajaj Finance Limited achieved a remarkable 57.7% compound annual growth rate over a 10-year period as of August 2021, and Eicher Motors Limited demonstrated a 33.9% annual returns over 10 years. As the legendary Peter Lynch, who achieved a remarkable 29.2% annualized return, famously observed, "Big companies have small moves, small companies have big moves." This strategy demands a deep understanding of the business, analyzing financial metrics like PE ratios, and a willingness to embrace higher risk for potentially massive rewards. Moving on to strategy number 2, momentum investing. The trend is your friend. Ever felt the thrill of catching a perfect wave, riding it until it crests? That's the essence of momentum investing, hopping onto stocks or assets that are already soaring and riding that upward trend. It's about buying what's hot, leveraging market psychology and the powerful fear of missing out, FOMO, to your advantage, and knowing exactly when to exit as the wave weakens. Think back to crypto in 2020 to 2021, where Bitcoin's parabolic rise pulled thousands of other coins with it, or the incredible run of Tesla from 2019 to late 2021, rewarding savvy momentum traders. This isn't just theory. The Invesco S&P 500 Momentum ETF boasts a 1-year return of plus 29.4% and a 5-year return of plus 22.2% compounded as of June 30, 2025, significantly outperforming the S&P 500's returns. A striking example from India is State Bank of India stock. On February 7, 2024, after breaking its all-time high, it delivered an impressive 12.86% return in just 7 to 8 days. Momentum can turbocharge your portfolio during bull cycles, accelerating returns well beyond the market average. But remember, every wave eventually breaks. Discipline is key to knowing when to dismount. Before moving to the final strategy, please like and subscribe to this channel to help it grow. At number 1 is dollar cost averaging or systematic investment plan. Ever felt the anxiety of trying to time the market perfectly, wondering if now's the right moment to buy or sell? What if there was a simple, emotion-proof strategy that could build significant wealth over time, regardless of market ups and downs? That's the magic of dollar cost averaging or DCA, known in India as Systematic Investment Plan or SIP. It's about consistently investing a fixed amount at periodic intervals, buying more when prices dip and less when they're high, effectively averaging your cost and eliminating the stress of market timing. DCA is your ultimate emotional armor, especially for beginners. It removes the pitfalls of greed and fear, letting you harness the true power of compounding through consistent investment. This isn't just for stocks. Imagine a steady Bitcoin or gold SIP capturing long-term gains without the constant worry of market ups and downs. Let's look at the incredible impact of a monthly 5,000 rupees SIP in India, assuming a 14% annualized return, 10 years. A 6 lakh investment grows to approximately 12.46 lakhs, which is a 2.08x wealth to contribution, 20 years. A 12 lakh investment blossoms into approximately 58.67 lakhs, which is a 4.89 times wealth to contribution, 30 years. A 18 lakh investment compounds to an astonishing 2.3 crore, yielding a remarkable 12.78 times wealth to contribution. Top Indian mutual funds demonstrate this power. The Quant Active Fund had a 5-year return of 31.48% and a 10-year return of 21.87%, compounded as of 2025. The Parag Parikh FlexiCap Fund showed strong performance too, with a 5-year return of 26.41% and a 10-year return of 19.28% compounded. These aren't just numbers, they're testaments to the profound impact of time and discipline with DCA. The journey to early retirement, while challenging, is entirely achievable through disciplined and strategic investment. The 5 strategies discussed each offer unique pathways to wealth creation and market outperformance. As promised earlier, here are 3 crucial nuggets to truly fast-track your journey to financial freedom that can help you to retire early. Don't try to time the market. As legendary investor John Bogle famously said, "Time in the market is more important than timing the market." Consistent, regular investing, regardless of short-term fluctuations, is a proven path to long-term gains. Reinvest. Maximum. Whether it's dividends, bonuses, or any other additional income, consistently reinvesting these funds back into your portfolio supercharges the power of compounding, accelerating your wealth accumulation. Diversify with blend of strategies. A diversified portfolio with a combination of 2 to 3 investment strategies, as discussed in this video, can help navigate different market cycles more effectively, thereby smoothing overall returns and mitigating risk for a more stable path to early retirement. Ready to take control of your financial destiny? Subscribe to our channel for more exclusive insights and watch our other videos on how to develop a rock-steady money psychology. Your future self will thank you.